We run into this all the time. How can a business owner avoid surprises, especially surprises that sink the company? Well, the setup usually goes something like this. You know, as a business owner, you have dreams, visions. But to execute those visions, you're going to need resources, usually money. And ultimately, pulling the trigger on the dream will be based on a number or numbers. How much does the dream cost? How much do we have to spend right now? Where are we as a company? But what if your information was wrong? What if the information you used to give the green light on that project was missing something, and missing something big? So you see the numbers you're looking for, and you act. Meanwhile, while you're thinking everything is fine, there's an error, a missing piece of information, and it's growing and growing larger. When it's finally discovered, it literally sinks your boat. So how can a business owner avoid this kind of a surprise? Well, let's look at a little accounting 101. Basic financial statements for your business are a balance sheet and an income statement. Think of a balance sheet like a photograph. It's a picture of your business at a point in time. Assets, what you have, minus liabilities, what you owe to others, equals what's yours, equity. The income statement tells you revenue received or earned less what you spent or incurred, depending whether you're a cash or accrual basis business. Net income or loss is the change in equity from the beginning and ending balance sheets for the period measured, let's say a month. So what could go wrong? Well, let's say there's something on your balance sheet that's not real, an unsupported balance, or the absence of a balance. It could be an error in the bank reconciliation, or simply a stray entry put there by a data entry clerk who didn't know where to code the transaction. Let's also say it starts to become big, and over time, it gets bigger. When you eventually discover it, there's only one place for it to go, your net income. So what does this really look like? $100,000 erroneous balance on your balance sheet becomes an expense in an instant. And the $50,000 in net income, the cushion you thought you had, becomes a $50,000 loss. So the moral of the story is, if you're rocking along thinking everything's fine, you'd better make sure the balance sheet you're basing your decision on is real. Otherwise, you could sink your boat.